So I think 2023 was a story about fiscal forces and monetary forces offsetting each other roughly equally. And if either one was winning, it was more the fiscal side. And what I mean by that is that throughout 2022, the Federal Reserve, as we all know, was tightening monetary policy. They were raising interest rates, they were reducing their balance sheet, and most assets had a very bad year in 2022. So stocks had a big problem, especially growth stocks. Bitcoin obviously went down a ton. Most other assets did poorly. Normally, in those types of environments, bonds hold up pretty well, but even they went down. And so, pretty much across the board, if you were not in cash or a small select set of idiosyncratic investments, just about everything went down.
In this discussion, Lyn Alden outlines the financial dynamics of 2023, highlighting the tug of war between fiscal and monetary forces. Initially, the Federal Reserve's tightening policies in 2022 led to a downturn in various assets. However, a shift occurred in late 2022 and continued into 2023 as the Treasury strategically countered the Fed's actions. By drawing down cash balances and issuing short-duration bonds, the Treasury injected liquidity into the financial system, preventing a potential second-stage crisis. Alden emphasizes the significance of these offsetting measures, underscoring their impact on global equity measures and highlighting Bitcoin's unique correlation with liquidity in the financial markets. Let's dive into the video to hear her full thesis.
Uh, but by early 2023, we started to see a little bit of a reversal. In fact, it kind of started in late 2022, which is basically that the Treasury began offsetting some of that Fed tightening. And so throughout 2023, the Federal Reserve has still been tightening. Rates are ending the year higher than they started. The Federal Reserve's balance sheet is lower than it started the year. So the Federal Reserve has, even though they've decelerated their course of tightening, they still are tightening. But what's different about kind of late 2022 and all of 2023 compared to the first 3 quarters of 2022 is that the Treasury is offsetting it, and they've done that in two primary ways. So from the fourth quarter of 2022 through the first 2 quarters of 2023, so that kind of 8-9 month period, they were drawing down their cash balance and pushing it back into the market. Partially that was because they had too much cash above their target, and then it accelerated because of the debt ceiling. So rather than emptying some of their cash into the financial system, they had to empty literally all of it up until the end of May of this year. Um, and then the second stage was that the Treasury then had a choice. If they went back to normal operation, you'd have the Fed tightening and there'd be no offset. And we probably would have had a second stage of liquidity crisis. Instead, the Treasury said, okay, we're going to issue a ton of short duration bonds, T bills. Instead of the longer duration, or basically the overall ratio of debt issuance is going to be very much skewed abnormally much towards that short end. And what that did was allowed money that was sitting in the reverse repo markets, which is, for lack of a better word, it's kind of money that's like excess demand for T bills. It's like excess cash that's sucked out of the banking system. It's kind of parked at the Fed, but not owned by the Fed. It's parked at the Fed. And issuing a ton of extra T bills allowed that capital to come in back into the financial system. And so that was another lever that the Treasury pulled to offset the Fed's quantitative tightening. And so, for example, bank reserves are not any lower now than they were in the banking crisis. That kind of stress tested their lower end, and almost a year later, 10 months later, bank reserves aren't any lower, even though the Federal Reserve has still been tightening, and that's because the Treasury has used these other offsets to offset it. And so basically the story over the past 2 years was, 3 quarters of tightening overall, Fed tightening, and kind of a neutral Treasury, and then about 5 quarters of roughly balanced Treasury and Fed actions. And so various global liquidity measures are higher now than they were in kind of the worst point, which was late 2022. And Bitcoin's price action and many other risk assets price action tends to be highly correlated with global liquidity. And it also just so happens that Bitcoin is, from my analysis, more correlated with liquidity than any other asset that I track.
In this next discussion, Lyn Alden provides a critical analysis of central banking, acknowledging their recent efforts but highlighting past missteps. She points out a miscalculation in understanding the quantity theory of money, leading to inflation surprises in 2020 and 2021. Alden notes that while not all inflation is the Fed's fault, they took measures to tighten policy once inflation surged. However, she emphasizes the challenges the Fed faces, particularly in dealing with fiscal deficits, which are beyond their control. Despite questioning the effectiveness of their model, Alden acknowledges the Fed's adherence to textbook strategies within the limitations of their tools.
So it's challenging because if you don't really think central banking is the best framework to begin with, it's hard to evaluate how they're doing. In terms of following their mandate, I think they're doing a fairly good job, at least in the past couple of years. I think they made missteps in 2020 and 2021 by not anticipating that inflation would come. I think they basically underestimated the quantity theory of money. The supply of money is not the only factor in inflation, but it's a big factor for inflation, and they severely underestimated it. I think their models were wrong, their theory was wrong, and they got punched in the face basically because of it. They got embarrassed. Now, not all the inflation was their fault. A lot of it was the fiscal authority, right? So it's not just the Fed deciding how much money exists. They're working with the Treasury to supply it. So it's not just them that caused it, although they contributed to it. Now, once inflation came, they pivoted and they got very tight, and which is generally what they're supposed to do. In that, they basically wanted to curtail credit growth. They wanted to curtail speculation. They wanted to bring down asset prices because that helps reduce demand and therefore get back to a supply demand equilibrium, which can help get prices down. I think the big challenge that the Fed faces is that a lot of this is outside of their control. Their tools are mainly around um, basically adjusting the level of bank lending. So there's really two main ways that broad money comes into existence. One is very large fiscal deficits are run and monetized by the central bank and the broader banking system. And number two is that banks decide to lend for various reasons. And for example, in the 1970s, most of the money supply growth was from bank lending. In the 1940s and then again in the 2020s, these were other inflationary environments. Most of the new money creation was not from bank lending, it was from monetized fiscal deficits. And the problem is that the Fed has no control over fiscal deficits. Their main tools are kind of built around the assumption that bank lending drives most money supply growth, and so they can slow down the rate of bank lending, which they've done. They can damage the wealth effect to varying degrees and therefore slow down spending, which they've at least for a while it was working. But their tools can't really address fiscal, which is the primary driver of inflation in this cycle. So given the tools they have, they're kind of following the textbook of what they should be doing. So it's hard to give them too bad of a grade, um, even though I think the whole model is challenged and antiquated.
In today's insightful discussion, Lyn Alden breaks down the intricate dance between fiscal and monetary forces shaping the financial landscape in 2023. From the Federal Reserve's tightening actions to the Treasury's strategic offsets, Alden navigates the complexities of global liquidity and its impact on various assets, including the unique correlation with Bitcoin. As we reflect on the challenges faced by central banking, Alden applauds recent efforts while critiquing past missteps, particularly in anticipating and managing inflation. The tug of war between the Fed's tools and the uncontrollable fiscal deficits adds an extra layer of complexity to their mandate. If you found this analysis valuable, don't forget to subscribe, like, and share your thoughts in the comments section below.